All right, everyone. Thank you very much for joining us on another iteration of our educational series here at Advanta. We do enjoy putting these on, and we hope you do get a lot out of them. Please make sure that you type in all of your questions as audio has been muted. I am happy to answer anything regarding retirement planning questions, whether or not it is directly related to Roth IRAs, Roth conversions, Roth 401ks, or the topic at hand. I am happy to address them. My name is Alex Perny. I'm a certified IRA services professional here at Advanta. I've been doing this for about 7 years. My contact information is directly up here. Everyone will get a copy of these slides and an email link to this recording as well, so don't feel like you have to take feverish notes. But if you have any questions that did not get answered or you'd like some further clarification, I'm always happy to schedule a consultation. My schedule is kept to do that just for that purpose. A few key points to take away are what accounts you can self-direct, Roth or not, the function and purpose of Roth conversions, some strategies associated with Roth conversions, and generally how Roth IRAs function, the history behind them, and everything that you generally need to know about these types of accounts. Who we are at Advanta, we have over 20 plus years of industry experience managing and administering self-directed accounts. We have over $1 billion now of capital assets under management for our clients, whether that is spread between IRAs, Roth IRAs, 401ks, and the like. And we do have dedicated service management here. So if you have the ability or the interest in self-directing, we do make sure that you get that personal touch. And we have our corporate headquarters down here in, albeit a slightly cooler day today, sunny Largo, Florida, and a satellite office in Atlanta, Georgia as well. So to give a little bit of background on the Roth IRA, from 1974, with the passing of the Employment Retirement Income Security Act, or ERISA, in 1974, which created 401ks and IRAs, to 1997, the only option available to those looking to contribute to an individual retirement plan, so i.e. those people not covered under a pension or benefit plan, was the traditional type IRA. With the Taxpayer Relief Act of 1997, the Roth IRA came into existence. So the first year that you were able to do this was 1998. So the first Roth IRAs that came into existence were that year, and the EGTRA passing Tax Cut Act of 2001 created the Roth 401k account feature as well. So also a very powerful tool that we'll talk about as well that loops into not only Roth retirement planning, but also Roth conversions as well. So important to understand that if you didn't know, Roth 401k can also be made into a Roth, and most employers will offer a Roth component. The key being in there is that you are not taking a deductions for your payroll election to contribute to that plan. So what exactly is a Roth IRA? People throw it around a lot. They talk about tax-free compounding interest and throw out all these fancy numbers and always are telling you to have one. Well, why? Well, the benefit to a Roth IRA is that it's a personal retirement account, meaning one that you open individually for yourself. It's not necessarily tied to an employer, although you can, as I said, have a Roth 401k. You do not take a deduction for adding money in there, so you are using after-tax funds that you have already paid, Social Security, your required minimum taxation, W-2, Schedule C, earned income, and in some cases Schedule E, but for the most part it has to be active earned income is going to qualify you for contributing. That is the money you take out of your own pocket per year to put into money to one of these. Then the funds grow tax-free. Now, the analogy I like to use for a Roth IRA versus a traditional IRA is that a traditional IRA, you pay no tax on the seed that you plant and pay tax when you pick the fruit off that tree in retirement. Whereas with the Roth IRA, you pay tax on that seed, and then once that tree grows, you pay nothing to take the fruit off of it in retirement. Now, Roth accounts must be open for at least 5 years, and you have to be 59 and a half to enjoy the tax-free distributions. But one really interesting functionality of a Roth IRA is it does have kind of a built-in savings account to that, and I'll get to that in the next slide, or the next couple slides. Now, when it comes to moving money into an IRA or just a Roth IRA or any retirement account in general, this is kind of a pet peeve 2 slides that I like to put out there so people understand, especially with tax planning coming up, of what this might mean for your tax reporting requirements. Now, when you think about moving funds from a retirement account to a retirement account, the ubiquitous term is, let's do a rollover. Well, that doesn't always necessarily apply. If you are moving funds between a traditional IRA, a SEP IRA and traditional IRA, or 2 same name type and tax qualification IRAs, I encourage you to do a custodial transfer. They are non-reportable, and the amount that you can do is unlimited. A rollover is a very specific type of movement of funds, which actually generates a 1099-R and also generates reporting on the receiving custodian side to make sure that it is not taxable. Now, again, Direct rollovers from a 401k or employer plan to an IRA are unlimited, and doing them between Roth or traditional makes no difference. But do keep in mind that you do have a 1099 tax report done from the issuer, the account that it's coming from, and tax reporting requirements on the receiver, the new IRA, to make sure that it is non-taxable. Now, obviously, there is human interaction involved in all of this, so making sure that you do get all the correct tax reporting documents is paramount. Otherwise, the IRS might think that you have a large 100,000, 200,000, however many thousands of dollars it is out there floating that you should have paid tax on when there was just a simple form not filed. So just understand the difference between a transfer and a rollover can be quite significant, especially when it comes to making sure you have all your tax documents in order. Now, as I mentioned, we are going to get into the basis of different types of self-directed plans. Which ones can be Roth, which ones cannot be. Just something I like to let people know is that there are many different types of accounts you can self-direct. Maybe you come out of this presentation today saying, you know what, I can't necessarily make a Roth IRA work, or none of the strategies really apply to me. Well, there's still plenty of strategies to get involved in self-direction that don't involve a Roth IRA, and there is no such thing as an investment that you have to have a Roth IRA for. It is kind of a common misconception that we run up against, that people think that, oh, well, if only I had a Roth IRA, I could get involved in this real estate deal, or, you know, I really can't justify doing this type of investment because I don't have the Roth IRA. All of these accounts, with regard to taxation of the life cycle of their investments, are treated the same. So a traditional IRA holder, if they have a rental property in their IRA, they're paying zero tax on any rental income or any of the tax on the sale gain when they sell a piece of real estate. Same thing with the Roth IRA. The only difference, remember, is that you do pay tax coming out of a traditional IRA in retirement, and you don't in a Roth IRA. But all of the activities of the investments, so the buying, the selling, the trading, the increase in value, none of that has a taxable consideration to give during the life cycle of the investment. So just keep in mind that, again, if we come out of this presentation today and you don't necessarily have the groundwork to do a Roth IRA or a conversion, that any of these other types of accounts up here can be self-directed. You can get involved in the things that you'd like to do. You just may not be able to utilize the Roth for that. Something good to understand is that we do have contribution limits for this year. Now, they are going up next year. We do get a $500 bump, so it's the first one in about 4 years that we have gotten for the amount of money that you can take out of your personal pocket and put into an IRA on a given year. So currently, the Roth and traditional IRA for money that you can take out of your wallet and put in there on an annual basis is $5,500 for individuals under the age of 50 and 1/2, and $6,500 for those individuals over the age of 50 and 1/2. Now, we get a $500 bump to each one of those, so something's better than nothing. So that's $6,000 and $7,000 respectively for those over the age of 50 for next year. And that's also going to carry over into SEP IRA annual contributions and 401k annual contributions of deferrals as well. We haven't heard whether or not they're going to increase the ESA or the HSA cost of living adjustments. I would imagine not, since we did get a bump of the health savings account contribution limits last year, up from $3,400 individually and $6,750 for the family, up to $3,500 and $6,900 respectively for that type of plan. So just understand that we're getting a little bit of a bump next year. Something's better than nothing. But now to get into some of the actual nuts and bolts of Roth and convertible accounts that you have. So there's different types of accounts out there that can be inherently Roth. Now, just because it can be inherently Roth or can't be does not mean you can't do a conversion. And it's important to understand, because depending on where you realize your income is ultimately going to make the difference as to what type of business plan specifically makes the most sense. And when I'm talking about business plans, I'm talking about I'm talking about 401ks and SEP IRAs. Now, when it comes down to a purely basic understanding of this, a Roth IRA starts out as a Roth IRA. No action needs to be done. A traditional IRA, you take a deduction, you can convert that to a Roth IRA. Now, with the traditional IRA, or we'll start with the traditional 401k, Roth 401k, and SEP IRA, there's a few other considerations to look at. So with that said, what you need to understand is that if you have a traditional 401k, that means that the contributions that you are making to that plan are getting a deduction for the $18,500 potentially maximum that you can put in there that is coming directly out of your paycheck. So you're getting to reduce that. You're not paying taxes out of that. Nothing else is necessarily being taken. So you're getting the tax-deferred growth in a traditional 401k of the amount that you're putting in directly. Now, if you have a profit sharing match, because there are two portions to a 401k, the profit sharing match, which can be up to $35,000 or 20% of the net operating income of the business, always has to be made traditionally to a 401k, meaning that that is always a deductible amount to the 401k. Now, with a Roth 401k, the $18,500 and you do have an additional $6,000 catch up for individuals over the age of 50 and a half. The Roth 401k, when you're talking about it in a purely top-down, very basic sense, means that you are not taking a deduction for the money that you're putting in to the plan out of your own paycheck. So very basically, if you look at it like that, you're always going to have a traditional and a Roth portion if you do just a basic Roth 401k. Now, there are some strategies associated with that. If you were an individual business owner and you utilize a solo 401k or it's a spousal 401k, meaning that you and your spouse are the equitable owners of the business, or even if it's just an owner-operated business with 5 owners in the business, the ability for you to kind of get creative with that is really interesting. So to make that profit sharing match of the 20% of your net operating income, that can be converted. Now, if it is a safe harbor, meaning that all of the profit sharing contributions are fully vested to all of the employees, and with a solo 401k they are, then you can essentially take the $18,500 or the $24,500 that you put in on an annual basis, take no deduction for that, and then if you have the ability to max out the $35,000 per participant profit sharing contribution, you can convert that, getting almost up to $60,000 a year into a Roth type plan, completely above board. There's no like sort of tricks of the trade or anything go along with that, but you do have to be able to take and claim that additional $35,000. Of course, that's a maximum figure as taxable income for that given year participating in that plan. But that is a really cool function of the 401k, is that you can do a partial conversion of that. You can do a slightly less, or so you can do a full conversion of it, but you can get a lot of money into that, or you can just take the advantage of having the non-deductible contribution and an offsetting corporate deduction, especially if your tax is an S Corp or something that passes those deductions along personally, can really be an interesting strategy along with that. Now, a SEP IRA is kind of an interesting one to look at, because when it comes to SEP IRAs, the contributions that you make to these are always deductible. They're always traditional. So why do we put it up here for the Roth IRA conversation? Well, the reason is that you can make your SEP IRA contribution and immediately convert it. There's no seasoning. There's no time period that you have to leave with that. Now, why would that necessarily be attractive to someone? Well, the benefit of having a 401k versus SEP IRA ultimately comes down to how you realize income in the business that you operate. So for individuals, and especially for people like realtors or people that have high ordinary income, if you're going to be a service provider, or let's say you run a management company where you are doing a lot of service and generating a lot of personally taxable income, well, the SEP IRA is going to help you reduce that. So the SEP IRA works on the principle that you can defer up to 25% of your base salary not to exceed $55,000 annually, plus your annual contribution of $5,500 or $6,500 to a traditional IRA. Because a SEP IRA essentially has two parts. It has the SEP contribution, which is that portion of salary deferral, which is initially deductible, and the traditional IRA contribution. Well, you can make that entire contribution to a SEP IRA and turn around and convert it. You do wash out the ability to have that deduction, but essentially the nice thing about that is, since it's treated as ordinary income, all of your taxes, credits, and deductions that go into reducing your modified adjusted gross income at the end of the year help to affect that. So if you have losses that carried over from a previous year, if you have a large amount of deductions, if you have current year losses that you want to claim and not carry forward and then spread out, you can do that and help to offset Roth conversions with a SEP IRA. So ultimately, depending on where you realize your income, and I should probably go back, and the reason that the 401k is inherently attractive is that if you have a business which can keep a lot of the income as operating income and not pay out much W-2 or Schedule C earned income to the employees, then the 401k makes a lot of sense, because you have that profit sharing match and the elective deferral, and the $18,500 or the additional $6,000 that you make as an individual over the age of 50 and a half, there's no sliding scale for that. So there's no 25% of your income factor for that. You can make 100% compensation contributions to a 401k, essentially washing out, if you're trying to do a traditional and gain deductions, washing out any ordinary income that the individual might see for a given year. So with that in mind, it's good to understand where all of these factors play in Now, just because you need to start with a deductible contribution type plan, be it a SEP IRA or traditional 401k, does not mean that you can't strategize and then do the Roth conversions at a later or an immediate date to help you get to that point that you're looking at, or get to the goal that you're looking at. Now, and I probably should have put these a little farther back. It's important to understand the things that you cannot invest with, and this goes for a traditional IRA, Roth IRA, 401ks. This applies to all of them equally. So there are certain things you cannot purchase. You cannot purchase a life insurance policy because they are typically paid out tax-free for the most part, and then you cannot buy anything that derives its value from collectability or inherent subjectivity. So antique, alcohol, artwork, stamps, and coins. The reason being is that there really isn't any inherent non-utilization personally for something like that. That's just the way they work, and that is the rules for it. It's also important to understand whom you cannot deal with. You cannot buy, sell, or have anyone benefit from an IRA-owned property or asset, for that matter, that is your spouse, a lineal descendant or ascendant of you personally, so parents, grandparents, children, or spouse, or a business entity owned or controlled by any of the above. With that said, the IRS, for whatever reason in their infinite wisdom, has decided that brothers and sisters are non-disqualified individuals. If you are interested in dealing with a sibling, I do encourage as strongly as I can, without saying, without giving advice, that you do it on a fair market value basis. I have not seen the IRS necessarily have an issue with under fair market value things, but it would go to reason that if you ever were to be audited and you were doing deals that were well below market value for whatever reason with a sibling, that they would have a significant problem with that. So what are some of the considerations for Roth IRAs? What's essentially the argument for having one? Because people say that, well, if I can get a deduction and reduce my taxable liabilities now, then why inherently would I want to pay tax and then add money into something that I can, then no longer have the ability to touch for years to come? Well, the nice thing is that you get to have tax-free earnings and no taxes on your withdrawals. So you tear the Band-Aid off now, and with the general trend, obviously, we are at almost historic lows for taxes right now with the current tax plan. Taxes as a general trending graph go up over time. If you're looking at this from a amortization standpoint, you can almost be guaranteed that expenses will increase, inflation will rise, and taxes will rise accordingly. So with that said, the Roth IRA, being able to pay your taxes now and then not have to pay a potentially higher tax rate later, even if you are making less income, can certainly be very attractive. Now, one thing that a lot of people, especially those that are reaching up towards the age of 70 and 1/2, want to be cognizant of is that there are no required minimum distributions with a Roth IRA. With a traditional IRA, for those of you that don't know, when you reach the age of 70 and 1/2, you have to start factoring out minimum withdrawals because you have taken deductions over the years for the money added into that plan. Now, the government wants to get their cut of that, so they say that, instead of being able to keep that non-taxable, and then if you were to die, they would never have any ability to collect on that. They say once you reach the age of 70 and 1/2 with a traditional IRA, 401k, or SEP IRA, then you have to start taking out a minimum amount of money. Now, that amount of money is factored on your general life expectancy, whether or not you are married, and then a multiplication table that they publish and update periodically. But it works out to somewhere around just a little bit less than 1% to about 2% per year you have to take out of the plan. Now, if you're invested in highly illiquid assets, or you just don't want to pay the government taxes just because they want it at 70 and 1/2, the Roth IRA becomes very attractive because you have no required minimum distributions. Also, if you have potentially high deductible items and you have losses or something that you can carry into the current year and you're reaching that age, doing a strategy, especially towards the end of year right now, where you start converting your traditional IRA to a Roth IRA and getting those taxes paid, you do have that ability to kind of stave off or get as far away from or eliminate your required minimum distributions as well. Now, coming into required minimum distributions, if the government is saying you have to take money out, they're not letting you put any money back in to a traditional IRA. So even if you are still working well into your 70s and making earned income, you can no longer make your $6,500 contribution and $7,000 next year. Contributions into a traditional IRA after the age of 70 and 1/2. However, since you're paying taxes presently and taking no deduction, the government has no problem with you simply continuing to make contributions to a Roth IRA well into retirement past the age of 70 and 1/2. One thing I mentioned earlier is that with a Roth IRA, a good thing to understand is that people sometimes get mixed up when they think about a retirement account saying that, it's great, but I have to put money away. I'd rather put it in a savings account so that way I have access to it. Maybe you're just starting out. Maybe you don't have a ton of money to put away for retirement, but you'd like to start, or maybe you have a lot of expenses coming up that you just aren't sure about and you don't want to tie money up into a traditional type IRA where you have a 10% penalty plus taxes on your earnings that have to be considered with taking out before the age of 50 and a half. You have almost kind of a built-in savings account to a Roth IRA. All of your contributions that you make to a Roth IRA are going to inherently be considered basis to you personally. That means you can take out money from a Roth IRA tax and penalty free at any time, so long as that you still have contributions remaining in the account. An example, I myself, if I contribute $5,000 a year for 3 years, I have $15,000 of attributable basis to myself personally. If I have $3,000 of earnings on that, then I have a total of $18,000 in my Roth IRA. If I have a large medical expense, I need to buy a car, I need the money personally, I can take out up to $15,000 of that Roth IRA tax and penalty free. There is no cost to do that because I have added that money in out of my own pocket. I have already paid taxes on it. The only portion out of that total of $18,000 that I cannot touch would be the net earnings attributable to it, which is the $3,000. That I would have to pay taxes and a 10% penalty on in order to remove. But the nice thing about this plan is that it gives people the flexibility, especially when you think about younger people that don't have as much income to dispose on doing retirement planning, gives them the ability to have the security of having that money accessible to them directly, or anyone for that matter, without taxes and penalties. It's just so long as that you have contributions to cover that. And again, you do have a 5-year waiting period that you have to wait until you can take the fully qualifying distributions from a Roth IRA. That is something that you need to consider as well. So if you are of the age of 59 and a half and you've had a Roth, but let's say you only started it when you were 58, well, you have a few years to wait before you can touch those earnings. But remember, all of your contributions are always distributable tax and penalty free. The 5-year waiting period only applies to the earnings attributable to those funds as well. My apologies, only applies to the earnings of those funds. So there are some considerations for Roth IRA distributions. If you think about a Roth IRA, imagine a target that you're shooting an arrow at. There's a few different layers it has to go through. You have the target face, you have the backing, and then the board behind it. The target face is going to be anything that you have contributed into that plan is fully deductible, tax and penalty free. Then after that, you have your convertible amounts, which can be distributed tax and penalty free, but you do have to wait 5 years before you can do so. Now, the conversions, let's say you're of the age of 40. You'd have to wait till you're 45 in order to take a tax-free distribution of the convertible amount from that account. Now, any earnings attributable to converted amounts or contributions are going to be the backboard of that target, and you are going to have to wait until you are of the age of 59 and a half and the account has been open for at least 5 years in order to distribute tax-free. So you have a couple different considerations. Just because you convert something doesn't mean you can immediately distribute it. Now, the contributions are what you can always distribute tax and penalty free, and in order to get at those holdings, which are essentially the icing on that cake, you have to be 59 and a half, and then you also have to have the account open for at least 5 years. And there's ordering to that. You don't necessarily get to pick and choose what you are distributing from. There is ordering rules to that. So you have to go through that target in the order that I indicated. When you take a distribution from your Roth IRA, you first take it from the contributions. Then once those are depleted, then any converted amounts are where you are said to be taking the basis out of those. Then once converted amounts are exhausted, then the earnings attributable to both of those are going to be distributed. Now, it doesn't make too much of a difference if you've had the account open and you're 59 and a half, and you've had the account open for 5 years and you're 59 and a half. You don't really have to worry about any of that. But if you are someone that is younger and you do need to take money out, it's important to understand and keep track of your financial documents, because if you do have a hardship and you need to take money out, then you're going to really need to look at that, and you're going to need to kind of track that. If you have a CPA, it's easy enough. If you use QuickBooks or if you have just, general CSV files or a Quicken file from your bank that you make those contributions to. It's easy enough to track, but just keep in mind that you do have ordering rules associated with that. You can't necessarily pick one over the other, but at least it's ordered in the direction that you'd want to go anyway, because the easiest ones to get out tax and penalty free are the contributions, and that's what you do take out first. Okay, Anthony has a question. Is there a minimum dollar amount required to open a new Roth IRA? No, there is not, and the year in which you open the Roth IRA starts that clock for you. So what I'd recommend to people is that with it being almost December, if you want to get this started, you get a full 12-month credit for having the account open in this given year. You don't necessarily have to fund it with anything. I mean, if you want to fund it with $1, or some banks will even open it for you with no with no deposit. We certainly will open a Roth IRA with no deposit, but ultimately the impetus for having one is to invest and deposit to it. But the nice thing is that you do get a full year of credit. If you open that account on December 31st, you get a full year of credit. And the contributions for a Roth IRA can be made up until your timely filing deadline of April 15th or whatever day it falls. I think it's the 18th of April this year because it falls on a weekend. So that's something to consider. So you can open it this year, get the full credit. If you want to make a previous year contribution, you can open it next year, but you don't get credit for it being open last year. It's the date that it's open. So just make sure that you do that. Now you do not get to carry this forward to an extended filing deadline for this type of contribution. The only contributions you get to make to a retirement plan for a previous year is going to be for the 401ks and the SEPs. You do get to your filing deadline to make your extended filing deadline to make contributions to those plans for a previous year. So do keep that in mind for that. And then I do believe, and it's probably coming on the next slide, but I was going to get ahead of myself. So there are some other aspects of people that they think, hey, you know what, I can't make this contribution because I make too much money to contribute directly to an IRA. Well, that is true to an extent. There are phase outs for the ability of an individual or a married person to contribute directly to an IRA. When I say contribute directly to a Roth IRA, and when I say that, I am simply referring to the fact that you take money out of your own pocket and directly add it to a Roth IRA. This has nothing to do with conversions, and it has nothing to do with a non-deductible converted amount from a traditional IRA as well. So those phased out limitations, and this is for modified adjusted gross income for the year of 2018, these numbers will be going up by, I believe, about $3,000 across the board next year. So just keep that in mind. I don't think they have finalized. I've seen some preliminary ones, but they might have finalized them already. So for a single individual, meaning that you are filing single, if you make between $120,000 to $135,000, that is your phase-out range. So if you make $119,999, you can still make a full contribution to a Roth IRA, meaning $6,500 or $5,500. If you make over $135,000, you cannot directly add money into that plan. Married filing jointly is $189,000 to $199,000, and if you are married filing separately, it is $10,000 of annual income. Now, again, that is just for taking money directly out of your pocket and putting it in to a Roth IRA. Some people, and I don't necessarily like the term, refer to a backdoor Roth contribution. So there is no income limitation phase out anymore for doing a Roth conversion. Up until 2010, there was. But in 2010, we had tax acts passed that essentially got rid of the income phase out for being able to do a Roth conversion, meaning that it doesn't matter if you make $3 million a year, you can always convert to a Roth IRA. And you are never disqualified from adding money to a traditional IRA, albeit your deduction might be removed. So if you make a non-deductible contribution to a traditional IRA as an individual making over the limits right here, which mirror the phase-out deductibility for a traditional IRA, then you can just directly convert it, and the form I believe is 8606, to a Roth IRA. There is no limitation. So even if you do make too much money to add directly to a Roth IRA, then you can certainly still do it. You can open one and do a conversion and essentially do the same contribution as if you were to do it directly to that plan. So it's a weird rule. There is a perfectly legal way around it. There is nothing wrong with that. It's just the way that you have to play the game if you do want to make that contribution to a Roth IRA. Now, every time that there is tax implication, there is things in the legislation that come up and people want to start talking about, oh, well, they're going to get rid of Roth IRAs and this, that, and the other. Personally, I don't believe that, because there is an inherent very big issue with the government saying, okay, great, well, we're going to give people the ability to pay us less money, but we're going to have to carry forward on our books potential future income that we're going to get. Now, with people living longer and longer and longer, that forecast gets harder to predict, especially when you're giving people deductions and not getting any taxable income from the traditional IRA market. So the effect of traditional IRA contributions, if you have 100 individuals all making $5,000 contributions to traditional IRAs, it results in $500,000 worth of tax deductions. If taxpayers' average rate is 20%, this results in $100,000 of lost tax revenue that the government receives. You can multiply that with the actual number, and then you can see where that goes. Down the line, the IRS will receive tax revenue on those distributions. But again, the only factor that they have to go on is the required minimum distribution. They have no basis for saying, hey, they're going to take out a large lump sum so I can count that. They can only factor in for their budgeting the required minimum distribution when someone reaches the age of 70 and a half. And even that has some fluctuation with the total account balance, assuming that there is positive growth from that can be even further reduced if there isn't much money left in that account. So, and think about it this way, if there were to be a full loss to the account and they were to have gotten deductions for adding money in there, the government could receive zero from contributions to that account if it was wiped out. The effect of the same pool on Roth IRA contributions, however, is that you have 100 individuals making $5,000 to Roth IRAs. Now, the government presently has $100,000 more dollars. They just made $100,000, whereas opposed to they gave $100,000 back to the individuals that they get to claim on their rolls now. So really, it's a cost benefit in the present budgeting of the government to allow for Roth IRAs, because it doesn't allow people to carry on down the road with creating those deductible amounts. The effective tax rates may go up, but essentially the government gets to collect on that now and use it for things that they need. So that is kind of my example why I don't think these things are ever going to go away. Some people with a sound mind in government that are making the final decisions, I'm pretty sure can see that. It's just it's an easy low-hanging fruit for people to say, well, these people are putting in all this money and paying no taxes on the way out, but essentially they are paying the government now for the benefit of not paying them later. So you be the judge of that, but that's kind of where I come from with my point of view professionally on the benefit to the government for continuing to allow this. So I don't think that it's something that's going to get axed anytime soon. There's never any time like the present to get started with this, and for the most part, if the government ever does do away with a plan, if you have had one, you are grandfathered in. Think back to things like Archer MSAs and Keogh plans. There is, those, you can certainly still have those. You just can't start new ones. So if you are concerned about that, go ahead and start a Roth IRA, because that's going to really be the only way to ensure that you can enjoy this is by go ahead and starting one now. So I keep saying conversion, but we haven't necessarily really defined what exactly the conversion is. In simple terms, it's taking an account that you have already paid tax on and then transferring those funds, contributing those funds to a tax-free account, a Roth IRA. You're electing to pay those taxes now. Now, you can do a Roth conversion of a SEP IRA, so your full elective deferral of your compensation. You can do it of a traditional IRA, you can do it of a traditional 401k, and you can do it of the profit-sharing match of a Roth 401k. Because remember, the profit-sharing match of a Roth 401k is always made traditionally. So you have 4 different options when it comes to saying, hey, I have a pool of money that I'd like to go ahead and pay taxes on now and get it into a Roth. Well, how is that taxed? When you do a Roth conversion, and it doesn't matter whether that's from the profit sharing of a 401k, it doesn't matter if it's from a SEP IRA or just a regular traditional IRA, you always pay that as ordinary income via a 1099-R. It just adjusts your MAGI up by that given number. If it's $1,000, you just factor in an additional $1,000. And remember, your tax credits, deductions, and losses all help to affect that total number. So if you do have a year where you have high deductible expenses, you have heavy losses that you're carrying into that year, those are the years that are very good in order to do deductions, or especially now that we have such a and for some people, reduced taxable liability, it can really make it an advantage to go ahead and start doing that this year if you maybe in other years didn't have the ability because of your tax bracket to take advantage of that. And then going forward, once you've done the conversion, all of the funds grow completely tax-free. So what to consider for Roth conversions? You have to make it by December 31st. You cannot do a previous year conversion in the taxable year of the following year following the year you wanted to make a conversion. So if you want to have that counted this year, you have to do it this year. The losses that you have to be realized the year that you are making the conversion. So you cannot go retroactively back and then reduce the amount if you're refiling taxes. If you go back and refile a return, the only amount that you cannot remove and adjust for is any converted amounts in that given year if you have a loss that you want to carry back and refile for. And conversions can no longer be unwound by recharacterizing. Prior to the passage of the current tax law, and it was any conversion made in the year of 2017 could be reconverted, but any conversion made in the year of 2018 going forward until at least 2025, I believe, is when revisions and expirations happen on the current tax bill, you are set in stone if you do that. You can unwind it present year if you work with your custodian, but the second that the clock strikes midnight on December 31st and it's January 1st, that Roth conversion is set in stone. So it does take a little bit more forward tax planning and a little bit more insight as to what your taxable situation is going to be. But again, it's just something to be cognizant of. It doesn't really change a ton. We as custodians of, you know, like I said, over $1 billion worth of assets, didn't do a ton of them. You know, on any given year, we may have in previous years, we do maybe 10 recharacterizations. It's just not that inherently something that happened a ton. So it's just something to be considerate of. You can no longer unwind them. It's a playbook you got to run with. Now, when you convert, again, this is just a good illustration of what that exactly looks like. If you're expecting large returns in the future, maybe that's a good time to convert. The traditional IRA contributions are non-deductible, meaning that you make too much money to take a deduction, so why not go ahead and put it in to a Roth IRA? Remember, if you convert a non-deductible contribution to a traditional IRA, that essentially is what they call the backdoor Roth conversion, and you're not paying any taxes on that as well. And if you have large personal losses in a given year, that's going to definitely offset the Roth conversion. So definitely a good time to strategize if you're going to be realizing large losses this year, especially, you know, depending on what you're invested in. If you do have personal stock losses, you can do a Roth conversion might be a very good time, or maybe the value of your assets is depressed because of current market conditions. Another good time to convert, because you can convert capital assets in a retirement plan. So if you have stocks, if you have a piece of real estate, you don't have to just convert cash. Your contributions have to be made in cash, but you can convert assets directly into a plan. Now, one other strategy that I do like to bring people aware of is that, especially with in-kind conversions, you're going to be talking about converting a potentially very expensive asset to a Roth IRA. Before I get too far into that, we got a question. Rental properties that I own outright, no loans outstanding, or even land that I won, is there any way to transfer that to an IRA so that I can avoid paying taxes on the rent and appreciation? Unfortunately, Joe, if you had initially acquired that within a Roth IRA, you certainly could definitely shield yourself from that. But with any type of retirement account, contributions have to be made in U.S. dollars cash. You cannot do an in-kind contribution, although you can do in-kind conversions. But if you personally owned it, you personally issued that money to closing, then they have to remain outside of the IRA, unfortunately. You know, there are some tax planning strategies with Internal Revenue Code 1031 that you can utilize when selling and reacquiring properties, but unfortunately there's really no basis for doing that within an IRA or a Roth IRA as well. But when it comes to doing conversions, you don't necessarily have to do it for just cash. You can do assets. And especially something that I'm working on with several clients right now is that with the end of the year, you have a nice benefit, is that let's say you own a piece of rental property in an IRA, and you want to get that into a Roth IRA. Well, what we require is a certified appraisal of the property. We're going to need a quick claim deed to move the property from the traditional IRA to the Roth IRA. But you don't want to necessarily pay taxes on, let's say, a $100,000 property in one given year. You don't have enough room in your current taxable income to qualify that. Well, what we can do at the end of the year, and this can go for anything, is that, like I said, when the clock strikes midnight on December 31st, you're in the following taxable year. So you can do a conversion on December 31st and count whatever portion of that conversion is that day. When we get back to the office on January 2nd, we can convert the other portion of the property and do an effective 100% conversion of the account and properties within that, and then you will have effectively split the taxable liability across 2 years instead of having to realize it all in one. So there's some definitely good strategies. One, with establishing a Roth account this year, especially at the end of the year, to get full credit for the 5-year waiting period on that account. And then also for doing conversions, if you want to do a full conversion or a conversion of a capital asset, such as a piece of real estate, a mortgage loan, an LLC interest, a trust, all of those different things can be done and split the taxable liability across 2 years just by the timing of when you do it. So if you're interested in doing that, or you want to get a consultation on some strategy with that, that's definitely something we can help you out with. I'm working with a client right now where we're scheduling the appraisal, because it's only good for 30 days, in the second week of December. So that way we have the time to do part of the conversion before the 31st, and then the first week in January do the other part of the conversion, thereby within 2 weeks, splitting his taxable liability across 2 years and doing a full conversion of the asset that he was interested in doing. So there's a lot of creative ways to get this done and not necessarily have to pay a ton of taxes in a given year. So just let us know, and we can certainly help go through that with you. And again, when it comes to which strategy is best, it's not something that we can necessarily tell you what's best for you, but we can give you all of the options and give you the playbook to go to your CPA or attorney or your advisor as to which one's going to be the best, whether or not you should be doing a Roth IRA or conversions, whether or not that this makes the most sense for you, and what is actually going to be a good fit. So I always tell people, have your CPA give me a call, or give me a call first, so that way you're not paying by the hour for someone's advisory time. I can get you through most of the basic questions without having to go and get someone on the clock that you're going to pay for that advisory opinion. So we can get you in and out of there without paying too much money. So again, we can't advise you, but we're certainly happy to schedule a consultation with you. And keep in mind that, especially if you're getting close to the age of 70 and 1/2, the only way to get rid of required minimum distributions is to either distribute the whole traditional IRA or 401k and pay taxes on all of it, and then have to pay taxes on all those earnings as well once they're outside of it, or start doing incremental Roth conversions going up to that date, so that way you can get everything into a Roth IRA and not have to start taking money out and depleting that account, especially effective if you have something like a piece of rental real estate or maybe a piece of land that doesn't generate income, to get that over to a Roth IRA, so that way you don't have to start doing in-kind distributions and start paying for appraisals on an annual basis to do that. So just something to consider. There's a bunch of different facets that run into that: avoiding required minimum distributions, avoiding taxes in the later future, and also trying to mitigate end-of-year taxes and future taxes by doing it stuff close to year end. So that's pretty much what we have for you today. Just wanted to make sure we get you out of here on time. This presentation runs a little bit shorter than other ones. If you have any questions, my direct contact information is up there. That is my direct line, 727-754-9954, and my direct email. Please give me a call. If there's any questions, type them in. Didn't have too many today, so I am more than happy to answer that. But thank you, everyone, for joining us. I hope everyone has a wonderful holiday and wonderful new year, and thank you for joining us today. Joe, unfortunately, there is no way to buy the property from yourself using IRA funds. The IRS covers that in plenty of different legislative issues with regards to tax code. Unfortunately, if you've already issued the wire to closing, there really isn't any way to get that in an IRA. But if you have not bought the property yet and you are still in the contractual or negotiation phases, we can get that contract redone and done in the name of the IRA, and you can close into the IRA. But you do have to do that before you actually essentially issue funds to closing. So unfortunately, you can't buy it from yourself if you've already issued payment. Okay, Debbie asks, explain again how to split the taxes over 2 years. So the way that works is that we got a few other questions if people want to wait around for. We're having a couple pop in, so I'll stay on and answer them as long as they're coming in. So Debbie asks how to split the taxes over 2 years. So a Roth conversion has to be done between January 1 and December 31 of the year that you wanted to count in. Since we're coming up towards the end of the year, you have kind of an interesting time frame. So on December 30th, you can do a conversion. Let's say you had $100,000 that you'd like to convert. Whether that's taxes or assets makes no difference. So you have $100,000 of total assets, let's say, that you want to convert. You can do $30,000, $50,000. You can do whatever amount of that you want to in this given year, and it will count on this given year's taxes. Now, if you'd like to then in turn do that whole $100,000, you just wait till after the first of the year, and then you convert the other portion of it. So essentially, within the span of 5 days, you can split your taxable liability across 2 different years, because after the first of the year, you can no longer count that conversion towards last year's taxes. So if you did $50,000 December 30th and then $50,000 January 2nd, you've done $100,000 of conversion in the span of 3 days that is counted on 2 different years' taxes. So again, if you have tax planning forethought to say, hey, you know what, I'm going to have a lot of deductions this year or last year, or whatever you're doing, it can certainly help to mitigate those taxes and also not have to pay it all in 1 year, possibly and typically bumping you into another tax bracket. Let's see, Doug asks, is it 50 or 50 and 1/2 for the catch-up provisions? It is the year in which you turn 50 and 1/2 as to when you can make the catch-up provision. So the additional $5,000 in a 401k and the additional $1,000 on Roth and traditional IRAs. So for example, my birthday is in December. It's actually coming up with a Sunday. So if I was turning 50 on Sunday, I could not make an additional $1,000 catch-up in a traditional Roth or $6,000 in my 401k. I'd have to wait till 2019 in order to realize that catch-up provision. John asks, if I convert 50% of my IRA to a Roth in 2018 and 50% in 19, and the product or investment grows greatly in 3 years, do I have to wait 5 years on each contribution, or only 5 years from the 2019 opening of the Roth account? So there's a few different aspects of that what you asked, John. So, excuse me, if you establish the IRA, let's say in 2018, and you convert from a traditional IRA in 2018, and then you convert in 2019, you're going to have 2 different bases of attribution to those conversions. Because remember, conversions have to age for 5 years if you're under the age of 59.5 in order to take those basis out tax and penalty free. Now, if you're over the age of 59.5, you only have to wait the 5 years from the date that the first one was open. So there's a few things to look at. So if you're over the age of 59.5 and you do conversions over 2 years and the start date is 2018, you just have to wait till after what? You have to wait till 2024 in order to start taking tax-free distributions out of that account. But again, it kind of depends on what your current age is and the like as to determine the determination of that. So I hope that answered that. Glenn asks, is the 5-year holding period for non-taxable Roth gains a one-time event from the opening, or a rolling date where prior gains would be taxable despite the account being open for 5 years? So the best way to answer that question is that, Mary, if you can type the question in, the raised hand function does not really do much. Sorry. The 5-year waiting period for Roth gains, essentially when you open the account, that starts a 5-year waiting period. Now, if you are under the age of 50 and 1/2, then that 5-year period essentially doesn't mean really much to you at all. So if you're over the age of 50.5, and you, let's say on your 50 and 1/2 birthday, you start a Roth IRA, and you do a sizable conversion, and then you have a bunch of earnings. The year after that 5 years is up, so one day after that, you can start taking tax-free distributions of all of it. But let's say it was before that, then essentially it's, once you reach the age of 59.5 is when you can start taking those non-taxable distributions. If you're under the age of 59.5, again, that 5-year period doesn't mean much if it's up, because any earnings attributable to anything in the account are always going to be penalized. You have to have the account open and be 59.5, 5 years, 59.5 to take those tax-free distributions. John, I think we got to the second portion of that. Guy asked, you are talking about funds out, but does that apply to investing those? But doesn't apply to investing those funds. Yeah, I mean, any funds that you have invested with regard to that, any earnings are unlimited. Those don't have anything to do with your contributions. So your contributions are the only ones that have the capped limits. There's no limit on earnings on any type of account, whether that's traditional or Roth. There is no limitation on converted amounts that got rid of in 2010. Glenn, I think I got that as well. Okay, Alexander asked, good name, Alexander. I share it. I converted my traditional IRA of $600K to a Roth IRA earlier part of 2018. Then I just withdrew $8,000 to pay for stock and futures trading. Is that taxable again because I am within the 5-year waiting period? I am 59.5 before I converted to a Roth. Then no, it should not be taxable because you are over the age of 59.5. All right, great. Any other questions? Mary, I see your hand raised. If you want to type in the question, happy to answer it. Okay, there we go, Mary. If I have an account that was opened February 15, can I withdraw March of 2020? I'm confused about whether you're counting a full year, regardless when the year opened, so I don't have to wait until 2021. I have reached 59.5. Mary, it just kind of depends. So the IRS is not exactly super clear on that. You get full credit for a year, so you open it in 2015, so you get credit for the full year of 2015. Now, you do have to count that as a full year, so 15, 16, 17, 18, 19. So in 2021, then essentially you absolutely would be able to take taxable, tax-free distributions. But remember, you can certainly take it in 2020, but remember, anytime before that, you always are going to distribute from your contributions to that plan first. So you kind of have that built-in savings account, if you remember. So you always are going to distribute from contributions first, so that 55 or 6,500 bucks you put in there. Then any conversions come after that, and then your earnings. So if you want to take a distribution of earnings, if that's implied in your question, then yes, you would have to wait until at least 2020 to do that. So you're completely fine in 2020 because remember 15, 16, 17, 18, 19. Those are your 5 years you have to be considerate of because you got a full credit year for 2015. So if you're talking about earnings in that, then yes. But remember, you always have access to those contributions as fully vested basis at any time. So it just depends on really where you want to take the money from or how much you want to take. Yeah, so the gains are taxable. The gains are what you have to wait in order to take from. So you have to wait to take any net earnings attributable. Yeah, you will get a copy of the webinar today, so it'll be emailed out once we get it all compiled. So just keep an eye out on your email. Check the spam folder. It should probably be hosted on our YouTube channel by Thursday, I'd imagine. Typically, that's about how long it takes our web development guy to get it out. Yeah, gains are taxable if you take them out before you are 59.5 and before the IRA is at least 5 years old. So that is when the gains are taxable. If you're over the age of 59.5, the account is at least 5 years old, then you get to take those gains out tax-free. So the gains are really the icing on the cake that you have to wait for all those particular considerations to be factored in. So that's what you got to watch out for, guy. All right, well, everyone, thank you very much for joining. I enjoyed the can I have an E-Trade account and a self-directed IRA? No, but E-Trade does offer IRAs, so you can certainly do a Roth IRA at E-Trade. No, that company is not connected with us. Do earnings, Alex asked that question, do earnings from Mary, do earnings themselves have to be in there 5 years? Like if gains came in 2019, do I have to wait 5 years? No, there is no tracking of basis for the gains. It's just any gains attributable to contributions or conversions. So there's really no really minuscule accounting you have to do. So it's just any earnings attributable is what you have to look at. It doesn't matter if they were realized in any given year. It's just any earnings attributable, which you have to wait that 5-year period in order to distribute tax-free. All right. My pleasure, Mary. All right, thank you very much for coming. I'm going to go ahead and wrap it up there. Thank you very much. Again, you will be getting links to all of this. And if you have any questions, again, my contact information is up there. I do actually enjoy this kind of stuff, so you're not gonna bore me with questions. So please ask them. I am always happy to help and be a resource. Thanks for joining.